Trideep Bhattacharya is now joining us. He's Chief Investment Officer Equities at Edelweiss Asset Management. Trideep, good to have you with us here. Good afternoon. Thanks very much. I mean, this is a re-rating of sorts for the broader markets, right? So it's kind of difficult to keep track of what's happening, and I mean, you can't possibly own everything. You got to just, you own what you own and then you watch the other stuff go up. How are you dealing with what you're seeing every day?
So I think overall, so far so good to answer your question. Yes, the market has become more broad-based, and when that tends to happen, more stocks than what you own tend to go up. But as long as the stocks that you have are also going up, we are in a good space. And fortunately, so far, that has been the case. I think the market is probably becoming more broad-based. Earnings, whichever stocks and companies have more earnings triggers, more bottom-up triggers, they are the ones which are kind of, outperforming the sector, and sometimes even in a debt sector, they are doing relatively better. So for stock pickers, this is a good market to be in, I would say.
Okay, Trideep, you sound, fairly pleased with the way things are set up. So that's good to hear. Afternoon, Nair Surabhi here. What's with the life insurers? What is happening with the sector? I mean, at the, in February after the budget, the market had completely sounded almost like the death knell. And look at them now. I mean, it has been probably one of the most breathtaking rallies in the large cap side of the market. What's your sense now, given where stock prices are?
So I think overall, this is the case. The sector is a case where expectations got lowered meaningfully, particularly in and around the budget, where people thought that overall, some part of the insurance market will become unattractive, and hence from that perspective, the sector might become dead. I saw some notes coming like that, and whenever these things happen, expectations usually are on the lower side. Fortunately, we held our nose at that time and held on to our stocks in that sector which we hold in our portfolios, and that has held us in good stead since then. But I think overall, it is not a question of the fact that the growth outlook has revived. It is a question of the fact, it's a question of the change in view, that the expectations got so lower that from there on the stocks have rallied with regards to kind of where things are. So I wouldn't go overboard at current levels with regards to insurance stocks, but happy to have the gains that we have of the stocks that we have in our portfolio.
All right, Trideep, we understand that. But, one of the themes that you've liked in the past is the defense theme, the Indianization of all the defense, expenditure that the government has to do. Prime Minister Modi is on his way to the US as we speak. Is there anything expected from there? And in defense itself, there are a couple of things. One, these stocks have run up quite a lot, with not a lot in terms of orders to show yet. And secondly, there are multiple forms. There's aviation, there's shipbuilding, there's defense shipbuilding, there's defense maintenance, there's defense software. What are the pockets that you like more here, and what are the pockets that offer value?
I think it's a great question. I would say that first of all, just to set the context right, in my opinion, this is a theme which will probably rhyme well in equity markets in India for the next 10-15 years. It's a fairly medium-term theme to talk about. At the moment, this is one of those opportunities where the opportunity size is big, in tens or 20s of billion, but we don't have the capacity or the wherewithal to supply that need. That will be the second point that I would make, that probably supply is less than half of what demand is at the moment with regards to this sector. And the third, I would say that within the listed space, if you look at it, the representation is kind of fairly limited, and limited only mostly to PSUs, and the weightages in the index is about 1.5%. This, if you take about 5-10 year view, this will probably be meaningfully higher from where we are, given the policy direction and how things are headed. So I think, directionally speaking, overall, the earnings, some of the companies have had their 20-year order book full in the way when they come and talk about in the earnings call. It's a matter of execution than otherwise. I'm not sure whether the US trip will lead to any particular announcement. Maybe it does, maybe it doesn't. But I think, more than just an announcement overall, if you include the private markets and public markets, drones, or some of the other categories like guns, this, that, the other, missiles, or air, whether it's Air Force, or Army. These are the two areas that we see meaningful amount of opportunity open up for Indian players. I would also put a final point that at the moment, the opportunity set within the listed space is more PSU oriented. Over time, over the next 2-3 years, you would see more private players getting listed in this space and private players becoming bigger. That will open up even more opportunities from where we are. So, as you can probably figure out, we're probably fairly positive on this theme. We own as much as we can in our portfolios and stick along for the medium term. There would be interspersed with disappointments, but I think those would be buying opportunities is the way I see, rather than kind of trying to trade around this theme.
Trideep, I'm looking at what you own across portfolios, right? This is top holdings as of the 30th of April. Stocks have done well. I mean, just so incrementally, where are you putting money? Fresh inflows.
Yeah. So I think incrementally speaking, overall, the way I read it is that the interest rates are probably close to peak, if not peak. And inflation is broadly kind of, peaking, and whether it will come down as in a jiffy or not, debatable. So incrementally speaking, interest rate beneficiaries or beneficiaries of sectors which benefit from, peaking of interest rates or lower is where the interest lies. And if you sort of mix that with some of the medium-term themes that we are positive on, I think real estate is one area, both direct and indirect plays, where we are incrementally more positive than where we were before. Some of the stocks have also, over the last 3-6 months, offered some sort of valuation comfort where we have sort of increased our weightage. We continue to like the industrial or the manufacturing side of the economy. We are overweight industrials, capital goods, manufacturing. We think it's a 5-year theme. And that continues to roar on with companies in the sector beating earnings estimates by almost about 20-30%, makes me believe that earnings are still undercooked in this area. And the area that we are underweight are consumption oriented and export oriented so far. That's kind of worked well for us. We will see at some point whether export plays become interesting or not. But at the moment, we are orienting ourselves towards manufacturing rather than consumption, domestic rather than exports, and incrementally more towards real estate is one segment that I would look to. In real estate and NBFCs, these would be the two spots that I would say where we have incrementally added over the last few months.
Okay, Trideep, just a final question then. Auto comes at the cross section of consumption and manufacturing. So is that overweight or underweight for you?
Neutral. As you said, it's at the cross section.
Brilliant.
I think in the autos, the segment is between autos and auto ancillaries. We see probably better value at the current levels within auto ancillaries, but we will be broadly neutral within autos in our portfolios. Some of our top picks have done quite well within autos, and I think the pent-up demand has held up quite well. The disruption driven by EVs, etc., it's something that one has to keep in mind. And companies which have the right model cycle, oriented in the right way with regards to EVs, is where we focus our attention in the context of the sector. So more selective than generally broad-based, more ANCs rather than OEMs, but the stocks have done quite well.
Since everyone's talking cross sections, should we also ask you your view on cement? Because that again is a cross section between infra play, between manufacturing, and it is manufacturing itself looking at some weakness in costs for cement companies. What are your thoughts here? Like any of them?
Well, positive. We are overweight cement. We think that overall it rhymes in well with regards to our thematic positioning of overweight industrials, manufacturing side of the economy. We think it fits in well with regards to the real estate side as well. So multiple levers to kind of give a top line fillip over the medium term. And plus the Scott side benefit with regards to petcoke, etc., is icing on the cake really. So we've been positive on cement for a while. We've continued to add in whatever weakness that we can get. And we like some of the bottom-up stories in this as well. Some of the company-specific nuances for some of the cement stocks make it even more attractive.
Okay, all right, Trideep, good talking to you. Thank you very much for joining in and telling us your preference areas in the market. Always great getting that perspective. Well, as we take the break, the news is